Has anyone ever asked you what your income is, and they mean your salary? Well, as a high income earner or corporate executive, you know that your salary is only one piece of your total income or your total compensation. Hi, I'm Michelle with Financial Design Studio, and today that's what we're talking about, one piece of your whole compensation package. So today what I want to touch on are a few of the key definitions that you need to know that affect these stock options. We're going to go through an example so you can see how the different dates affect you and these definitions too. And then also we're just going to step back once we see this example and understand the big picture. So let's go ahead and walk through some of these key definitions. First, I've listed them over here. We've got the grant date. Now you might be starting at a new company, or you might have been there for a while and your company is now offering you these NQSOs, and that could be because you're moving up into a greater role. These are typically reserved for certain types of employees. Now, I'm specifically saying a non-qualified stock option, and that's because there is a different type of stock option that you could be awarded, which is an incentive stock option, also known as an ISO. Now, we're going to touch on that in a different video, so you can see that there. However, there is a difference, and this non-qualified stock option is really just titled that because it does not receive preferential tax treatment from the IRS. And you're going to see that here in a couple different ways. So let's go ahead and dig into these definitions so then we can see the difference. First, let's talk through the grant date. This is simply the date that your employer specifies a number of shares that is awarded to you at a specified price. So for example, they might say today you're being given 100 shares at a strike price or at an exercise price of $100. So that is how it might be awarded. Now, at this point, you might be asking, great, I've been given something, but is there any tax consequences or anything I need to know? And the answer here is no. Just simply being awarded these shares, you do not have a tax consequence at this time. So there's nothing you need to do. Now, you might be subject to a vesting schedule. So let's say that they give you these 100 shares, but you get them over a period of 4 years. So maybe you actually own 25% per year for the next 4 years. There's lots of different vesting schedules, but you'll probably be subject to a vesting schedule. Next, we need to know the exercise date. Now, this is simply the date that you're actually purchasing the stock from your employer. So they said that they were going to give you stock for a certain price and a certain number of shares. Now you're going to exercise those shares, and that just means you're actually going to purchase the stock from your employer at that price in that amount. When you actually purchase the stock, consider that they are actually giving you money. They're giving you income or a piece of your overall compensation package. So you are receiving something in purchasing their stock. You're being given the stock. Now, you got it at a great price, so you didn't have to buy it for the price that you're getting it at today. So what you're going to do at this point, there is a tax implication that you need to take care of because you've received something. So you're going to recognize W-2 income. So just like when you're paid, you get a W-2 each year. You're going to recognize income on your W-2 on the difference between the value on the date of exercise, so this date that you're buying it, and the price that they granted it to you at. This is why these definitions matter. Now just wait, we're going to go through an example because I already know this could start to get confusing. Now the last piece, or the last definition we just want to understand before we go through this example, is the sale date. So you've purchased the shares from your employer that they said you could have, and now in the future, sometime in the future, you've decided, you know what, I actually want to sell these shares to take my money and do something else with it. And so now you're going to recognize a capital gain on the difference between the value at the exercise date when you purchased it and the value at the date sold. And this is fair market value at the date sold. So with all of these, there's very important details in here, but the most helpful thing is if we walk through an example so you can actually see what this really looks like, just so you can apply it to your situation too. All right, I've got an example, a timeline, so we can actually walk through what these definitions mean in real life when they're happening. So let's assume on January 1st, your company grants you 100 shares of their company stock. So I've got 100 shares, and we're going to assume that this is granted to you at $100 per share. So remember, this grant date is just simply your company saying, great job, we're awarding you 100 shares at $100 per share at some point in the future. Now, we said there's no tax consequences, there's nothing you need to do as of this date because you haven't really gotten anything. Now, you might be subject to the vesting schedule. So now we're gonna say, let's assume, and typically it is longer, but let's assume August 1st of that same year, you could actually buy those shares. They're available to be exercised. So now we are actually going to say that in August, we've got an exercise date, so we're actually purchasing these shares, and we're gonna assume that this was $120 per share. So we actually purchased the shares that we were given. Now, between this date, if we look back at our definition here, we're going to recognize W-2 income. So just like you get with your pay, your salary, you get a W-2 every year, you're gonna get a W-2, and it's gonna show the difference from 120, the fair market value on the date of exercise, minus the fair market value or the grant price that they gave you. So 120 minus 100, so $20 per share at 100 shares. So this is gonna be $2,000 of W-2 income that you're going to actually need to do something with. So now this is gonna be W-2 income. You're gonna pay payroll taxes on this, income tax, just as if you had earned $2,000. All right. Now you own the shares, so let's fast forward and say on December 1st of the following year, you've decided that you actually want to sell these shares. So we're going to say this is our sale date. And on this date, the shares have increased in value to $150 per share. So now you've got this time horizon here, and we've got $150 minus 120 times our 100 shares. So we've got $3,000 here. Now the difference here is that it's not W-2 income. This is actually going to be capital gains. So we're going to say capital gains. And the way that you pay tax on capital gains is based on the time horizon of how long you held it. So we owned it from the year 2000, August of 2000. Fast forward, August of 2001 would be a year. We held it longer than a year, so this is going to be a long-term capital gain. If we had held it less than a year, then we would have had a short-term capital gain. And there's a difference in how much income tax you pay, the income rate that you pay it at, whether for the short term or the long term. So these are all pieces that you need to be aware of. What's really helpful is you can see that in these time frames, you've got one transaction that happened, so you've got one tax implication to you, and then you can see, depending on what you decide to do with that, you've got a second tax implication. Now, a lot of times when we talk about tax planning, we're talking about long-term. We might be saying high-income earners and corporate executives, you are going to become near retirees and retirees one day. And so we don't just look at this short-term impact, but we also look at the long-term, because that can help us to actually decide, when should we sell this? And that date of when you should sell it can be based on a lot of factors. Maybe you want to give money away. Maybe you need money to fund a goal like your kid's education or retirement, or something along the way in preparing for retirement if you're wanting to buy a second home or move out of state. There's so many goals and there's so many different timings for what you need to happen. This is why tax planning is such a big part of what we do. So we've talked about one component of your total compensation. I just want to point you to our tax saving strategies downloadable that you can get in the comments here. take a look at that because it's got some really helpful tips or just information and strategies that you could implement as a high income earner, as a corporate executive, and then a near retiree, because all of these work together. So if this has been helpful for you, check out some of our other YouTube videos on our channel. You can also look at our incentive stock options because maybe you have 2 different types of options. So this explains one, but now you can go take a look at the other. And overall, this is just one piece of your total compensation. So if you have any other questions, please reach out. We're happy to help you.